following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi, folks. Basil Chapman, Tiger Technicians Hour, Monday through Friday, this time every weekday. And thank you to John Logan and then Tom O'Brien and Daryl Martin. 3 great hours just gone by. Very interesting. Tom was discussing the dollar. I thought, wow, I'm going to bring this chart up because part of the Chapman wave methodology is looking at the cup formation or bowl formation, if it's a very long flat-based bowl, or a cup or a very broad upside-down bowl. Very important patterns. Let me explain what I'm looking at here. If you look at the dollar, you see this. I can make it small. You see this pattern going from the left side high back in November of 2005 at 92.63. Well, what have we just gotten to this month of January? We've gotten to 92.53. Fascinating, huh? Here we are. How many years later? 10 years later. And even more importantly, the Chapman wave methodology, I love to show this type of thing. There's a technique I developed many years ago. Normally, I like to look for a plumb line. There's a certain way to decipher that plumb line. Plumb line is the price point that you take, and you say, if this is the halfway marker in time, within the same time span to the right side, we should get a retest of something significant on the left side. I had shown this as part of my, where did it go to? It was right here. Didn't I have it just a moment ago? Is it gone? Is it gone? My CD, introducing the Chapman wave methodology. That is interesting. Disappeared. Oh, I'll find it, don't worry. And most importantly, what we were looking at is in the cup formation of the dollar. This is a monthly dollar. And I chose quite some time ago to show the midpoint of June of 2010 at a high, not a low, but not a recovery high, but a significant high, as possibly being a left side half of a cup formation, and then we would see how the other half pans out. Well, a couple of things going on here. Number one is this is the month. I haven't counted the months, but count the years. 1, 2, it's exactly 10 years. If we go 10 years to the right, we get to the month of January. And in the month of January of 2015, what have we done? We've matched that exactly, and I've got it right there. There's the left side, LS, and here's the right side. Now, what's very important about this is that we once had an arch formation, and this was a plumb line that was exact. It was exactly to the high, to the recovery high. It went, I remember this so well, I was on my way with my partner at the time to Fidelity, and we were discussing all sorts of things, and I said, Andy, I got a low. I got a significant turnaround. It was 1995. I got a significant turnaround in the dollar. I think we're making a low of, this could be an important low. It was right there. The low was 80.05 in the index. It's changed a little bit. I don't think it's more than 1 or 2 points away because it's an index, so sometimes prices change, it gets smoothed out. But in this particular case, it was the low, that doji low of April of 1995. And the market kept going high. It went peak ABCD, and then it pulled back, and had another ABCD, then went to an E, pulls back, and then it goes ABCD, and then the third peak at an E right there, July of 2001 at 121, round number. Now, I remember it was a round number. I'm not sure it was 121, it might have been 122. However, a round number high. And what do? We come down, we make a cup formation in the Chapman methodology. That's really important. Make a cup formation, and then, lo and behold, you start on your way down. And this is what I've said. Oh, I don't know for how long I've talked about this, that in crash mode, you can take out the left side bars, either way on the, usually it's on the way down, of course, if it's a crash. You can take out in hours, 6 hours, or maybe 2 days. You can take out weeks, sometimes months worth of trading activity. But in a normal situation, what happens is you come back and you test that left side low bar in the same time period. And I remember I was on air. I'll never forget this. I was on air the exact moment that we took out the left side low of April of 1995, 83.03, right here at TFNN. It was in September of 2007. I said, we've just taken out the left side low in the dollar. It took an exact price, I mean, I don't even know how you can explain it. It was a pivot point. It was a plumb line in time, months. And you're going back from 1995, count the months, you've gone from 1995 to 2001. That's 6 years, so that's over 70 months. And it matches exactly from that high to the exact breakdown of the low. Bam. Takes it out, and then we went even lower to 70.70. Then we did the Chapman wave H formation that goes to an M, goes to from 70.70, makes a higher high at 72.70, and has had a tremendous move up to today's high, which on a monthly basis hits exactly the left side high of November of 2005, 92.63. Interesting. I love the way that works. I wonder if I can find my CD that shows this exact example. This is the dollar. I don't have the data going back anymore. I used to have. I don't know what they've done. Reuters bought this one, and each one has bought the other's index so that they keep starting the index over. I can't even find my CRB index, which went back decades. It was fantastic. I love having that historical reference point in the Chapman wave. I can get it elsewhere, but I want to have it on my chart. TraceStation doesn't have it, unfortunately, anymore in the very long term. So let's just go to the numbers. The Dow's now down two. This is so interesting. When I went through my the portfolio this morning, it's so interesting that I had. I'll show this example in a moment. I had a position that I was hoping would turn out to be an intermediate term position, meaning not more than a few days or weeks. It would be something we could actually hold for a while. And it was holding, well, it's still actually holding okay. But I raised the stop this morning, even though we just got into it. We just made a very nice profit. I wanted to go back in at about the price. We got out, and we got taken out today with a 1 point profit in this latest position. It's now down about a point or something from where we got in, but it's still within reasonable range. But I don't. This market right now is possibly one of the most ferocious in the whipsaw action since we've seen in late 2008, early 2009. If you are correct, you are correct stupendously. If you are wrong, stupid is the word. It isn't stupendous. It's stupid. You just feel like a dodo. I've tightened up everything. I'm making sure that my theory and my practice are going to make sure that the theory stays theory. The practice makes sure that we are tightening up everything. And I'll explain why as we go through these numbers. So let's just go there. I'll find my CD in a moment. Let's run this quickly. We got the Dow now under the 9-period exponential moving average. I said to subscribers, great action yesterday, but not good enough. If we take out the 17,720s to 17,700 key support level, and right now the Dow's down 210 at 17,698. That's number one. Number two is that the VIX index is bouncing off to making a leg D to the downside, the 120-minute chart. The 120-minute Dow has gone peak C1, C2. I typed it in this morning. and we pull back, and the volatility, the trend is actually rising somewhat, and that's at least recognizing what's happening. If you're looking at the daily chart, still not a big deal. We're still making higher highs and higher lows. But let me tell you something. I'll explain it as we go along. This is saying to me that even if we make those new highs that I'm anticipating, even if it's just nominally higher, 18,106 or 18,150, maybe 18,200 in the Dow, slightly higher in the S&P. It doesn't matter to me. What I'm looking at here is that there's something going on in the market that says the old shall become new and the new shall become old. I don't know, it sounds like a biblical expression. What it's really saying is that the sectors that have been absolutely on fire, you got the Macy's, just did a fantastic job. Gaps down, leg E, plop, peak E. Monday, the weekly chart is in leg E. This coming Monday, if we start much lower down, we might make a peak E. So it's leg E, peak E. So we've got peak E in the daily Macy's chart, trading at 65.60 down 2. You've got the weekly in leg E. You've got the monthly in leg D with a kind of a candle right here that says, gee, I snuck above the resistance, but I might have a little trouble here. Be careful. And that means you've got to directly relate it to the RTH. What's the RTH? The retail index. I've got it in leg C, maybe a peak C right now. But the negatives of the technicals are worrying me a lot. And I've got it in F/B in the weekly chart. And look at the weekly chart. Look at this, talking about formations. Look at that. There's that cup formation breakout, and you've gone to that doji candle right there in December. And January has this wide angle. MACD still good. Stochastics at 94%. Man, I got to tell you, this is the most interesting market we've seen in such a long time. Monthly chart. Look at this monthly chart. That is saying market vectors in the Fibonacci expansion. We've gone over the 261. We're making a very interesting candle in January. I'm suspecting that even if we do make recovery highs, this is the month that says, be careful, because at some point in the month of January or maybe early February, we will actually get that double-digit decline. There is still enough resources and enough strength for us to muddle through for a couple of weeks, unless, and I'll explain the unless in a moment when we go to the S&P. The S&P right now, SPX.X, whoops, SPX dollar, SPX.X, made a peak A. There's no other way I can count it. I've tried every which way. Yep, because that restarted over there. This has to be an A minus, or it's an A that's going to have an underneath it, an A, a B, then a C, and a D. But that weekly chart, look at the weekly chart. Even now, it's just on the 9-period exponential moving average. Doesn't look all that bad. Hey, I'll be back. We'll continue with this in great detail. Basil Chapman, Tiger Traditions Hour. Fascinating session. Up, down, down, down. Back.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Check out the new look of Tiger TV. Now you can see all hosts, charts, and computer screens live in high definition. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Thinkorswim, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV. Now, crystal clear in high definition, 24 hours a day, 7 days a week. If you haven't seen the new look of Tiger TV, then visit TFNN.com. Basil takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
So let me just run the numbers and we go to Mike in Miami. So we've got the gold up 10, 30. Let me just check what the current is. Yeah, about 10 at 12, 18. This is so interesting. Let me explain why it's interesting. You see the pattern that's unfolding. You see these arch formations, but you see how they're rising highs. They have rising lows. Hasn't yet, in this last move up, seen us from the last low, that is, rising high. So if all of a sudden we see 12.24 on gold, maybe today, that's saying, ha-ha. Now we've got rising highs and rising lows. That's very important. And then what happens, the weekly kicks in and says, hey, don't forget about me, because look at this. I've been building the technicals. My MACD's cross positive. Stochastic is rising. There could be a very sharp, sudden move in gold, and that's going to make this weekend, Sunday into Monday, very important in both the dollar. Now, I have the dollar. Now, it's fascinating. I'm going to do this real quickly. I'm going to tie in all the rest as we go to our next caller. I've got the UUP and alternate count in leg F today. A leg F in the weekly chart. This is UUP, is the trading vehicle, the power shares, DB, US dollar bull ETN, I believe it is. So that's the UUP. If you go to the dollar, Now, after a move like this, I'm not sure that I'm going to see the dollar just go shoop on the way to the downside. There will be residual buys, like the tide. Tide changes, but you still get those rogue waves that keep coming up. So I'm going to be watching the dollar very closely because the stochastic started to pull back. There's a divergence. The MACD is still very strong, and the weekly chart is superb. And it says 89.54 is the key support. The dollar's at 92.03 right now, 92.03, 92.18, somewhere around there. Now, what's really important about this is this candle here. There's nothing negative yet. But if you go to the 120-minute chart, you can see you made a peak D, you pull back very sharply, you went to the rectangle formation, broke under it. It's also the cup formation, the drop back that I have in the Chapman wave technique that I call that double top pattern. So this is going to be very important for the dollar right now because I'm beginning to see over the last couple of days tactical chinks in the armor. Let's put it that way. And real quickly, I want to go to bonds because bonds have had every which way. They held the 9-period moving average today. They are holding tightly. This is very important because my monthly charts and my weekly charts are still very strong. I'll get into that a little bit more as we move on. I do want to go to Mike in Miami. Mike in Miami, how are you?
I'm well, Basil. How are you?
I'm well, thank you.
I'm looking at IWM. What is the drag on IWM? Is it the fact that there's a lot of financials in it? Is that the main reason?
The IWM, that's the iShares, the Russell 2000. So those are the smaller caps. Mm-hmm. But I think that they have smaller oils in there. I'm not sure of the exact percentage of the mix. I could probably drag it up right now.
Yeah, no,
most importantly, what I would like you to consider is that the IWM, I mentioned to my subscribers this morning, this is a bullet point I always have in my Traders Corner. I have a paragraph for those who are too busy to read all the other stuff that I've got, just a summary of what we're looking at and why we're looking at it. And then I go through all about 15 different bullet points. And today, number 6 is GE. I always have GE, whether we own it or we don't, I always have GE. And I said, what an effort to rally. A negative sign, and I have to tell you, I've deliberated hard and fast on this idea that GE has been a bellwether in my Dow Quartet on the shorter term, and absolutely it did not rally with the market, and was saying that be careful, you could get a pullback. That's why I said that the 9-period moving average in the Dow at 17,720 to 17,700 is going to be so important because of that GE factor. I treat in many ways, I like to treat the IWM a little bit like I treat GE in my Dow Quartet. So if you think of the market quartet of the Dow, the S&P, the QQQ series, and the IWM, I would not ignore the NYA, but I'm just putting it aside for the moment. You could have the NYA in there if you wanted, make it a quintet. IWM, for a while, for a couple of years now, has done a bunch of things. And one is, it's actually led us to the downside and it's led us to the upside. And in this last move, it had a much better move than almost all the other indices because it broke above its recent high. Most importantly, though, what it failed to do in the weekly chart is, let me just show you what happened here. It has made the 120 to 121 area. What was the recent high? 121.41. So it's made the 120 to 122 area an incredible resistance range. So I'm going to answer your question in one way, but I'm also going to ask you if what your bias is. So let's go to the break and we'll come right back with that. Is that okay? Good. Sure. Be back with Mike. Dow's done 200 and I'll be right back with Mike.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. How would you feel if you had a powerful decision-making tool that has the ability to find high-probability trading opportunities across multiple time frames in equities, currencies, and futures? Search no more. Take advantage of the best trade with the TAS Profile Scanner. Trade with confidence and clarity while using the software that thousands of institutional traders rely on to help them make the best and most accurate decisions. Scan over 1,000 equities, currencies, and futures instruments for high-probability trading setups utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time, for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. Subscribers will also gain access to the December 9th workshop with John Logan. There's no obligation to pay anything. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated folic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. We're back, and we are talking with Mike in Miami. And actually, what's really interesting is we're talking about the IWM, which is at 117.70. It's down minus 1.01, down 0.85%. The Dow's down minus 1%, and the S&P's down minus 0.91. I see buying as if there's I see selling as if there's a vortex. There's no support, and then you go down to the next support. But now the real support has come in. If the support that the most recent decline in both the S&P, it doesn't matter whether it's the futures or whether it's the cash, this most recent decline, I'm talking about intraday in the last maybe 10 minutes or so, if from here there can be a rally, we could save the day with the 9-period moving average, and I'll talk about that as we move on. But I'm going back to Mike. So, Mike, what I just wanted to say is that failing at a peak C in the daily would be very unusual. Normally what you would get, as long as you don't break the low bar, which held the 200-period moving average on the 16th at 113.03, having bounced to 121.41, and then come back again in this H formation at 114.36. This rally that we've just seen, the one from yesterday, and then the reversal today, almost an engulfing candle so far, is saying that there is enough. Looking at the mix of the sectors in technology, industrials, financial services, consumer cyclical, healthcare, real estate, basic materials, consumer defense, utilities, energy, communication services, it's the percentage mix that I think failed to allow the Russell to move higher like the Dow and the S&P did, and then come back down. And on the way back up, I think it was the two sectors, the healthcare, to a certain extent, the real estate, consumer defensive, and a mix of the others, and utilities maybe, that allowed it to spiral back and to quickly make a new recovery high. So I'm looking at it, and the weekly chart is still, the MACD is still good, and the stochastic still at 90%. So let me ask you, is there a position that you wanted to take? Is this a query because you looked at it so closely, and what does it tie into?
I'm looking at a longer-term position to go long. I'm looking at ASG. And it's the closest chart I can find would be the IWM to this particular. It's a fund. It's called Liberty All-Star Equity Fund. Are you familiar with it?
No, I'm not, but I'm also looking at the chart, and it's got a very different chart pattern. It looks actually like a bond fund. ASG?
Yeah.
Liberty
ASG.
All-Star Growth?
Yeah. The reason its makeup is similar to that of IWM in that it has 30% of it are high-flying tech stocks.
Just one second. I'll tell you what I can understand about it right now. It is the percentages that are different, so that the patterns, in a sense, conform a little bit, but technology is only 16% in the IWM. Financials is 14 or 15. Consumer cyclicals is 13%. You get healthcare, 13%, and then they go down from there. So maybe it's the mix that's different, but the sector organization is the same. Just the percentages are different.
You know, as you see, ASG has been a laggard last year. I think it returned 1% after dividends. It pays like an 8-9% dividend. But, you know, if you had bought the October low, you know, and sold it to highs, you made 15%, yes. Right? So,
yes, the other thing, you know, I tend to do this with stocks. I pick a stock and I look at the chart pattern and I start doing the work and everything, and I look and I say, hey, that's only $1.03, or hey, that's $1,055. I don't look at the price until afterwards. So I'm looking at this and it's at $5.05. So in fact, yeah, it's trading like a fund would, and it has the percentages. It's down 1.37% today. So the percentages are going to be different, and also because it's such a low-priced issue. So, okay, now let's go. So actually, what you would be doing is, if you're looking at for a long term, it has to break the H that goes to an M pattern, which is exactly what's happening right now. No matter what happens, for this thing to really succeed, and it's a weekly basis I'm looking at, it has to close. ASG trading at $5.05 today, down only 6 cents, but that's $1.17. It has to close decisively above 524, the previous highs, 3 previous highs. It has to, within that up move, it has to tackle very quickly 537, the high of September of last year. And if I'm correct in what you're talking about in terms of buying it, you're looking at maybe this summer, as if you're buying it now. You're prepared to sit back, and if 505, as long as it doesn't take out the recent low, maybe.
I've got some lowball bids in it, and I'm kind of hoping that the market would sell off some more here, but it's reluctant to do so. So it may just be patience on my part.
Oh, then I know what I'm going to suggest to you. I'm going to suggest 2 frames of mind. One is, if you feel that you keep missing it, why not just nibble at it? I mean, it's at $5.05. You could start a position. I don't know what the lowest proportion is. I don't know if you're limited to buying it once in whatever it is that you're buying.
I have a tiny position right now. I sold out a larger position earlier. Made a little.
Then that's exactly it. So hold your tiny position. I would start adding to it if it closed for 2 consecutive weeks above $5.13.
Right.
Another small position. Have patience, because the rising trend line says that sometime in January, early February, you might be able to buy it back at $4.93 to maybe
Right.
even $4.83, somewhere in that range.
Okay.
And then you would know that you've got tremendous security, because the 200-period moving average that it respects a lot is at 473. I think
Right.
that's a much better risk reward if
Sure.
you're looking towards a rally that can go later on. I'm still very nervous about some kind of very sharp decline
Right.
in the coming along if we don't constantly rotate. Now I'm seeing fewer sectors that we're able to rotate into. I don't think you can just be led up by like autos or something like that. It has to be sectors where there are a lot of stocks, not just a handful, and it's got to be sectors that lagged before, maybe the financials, because rates start to move higher. I don't know, but as it stands right now, I'm going to go through the bond chart in a moment, and I think you've got the right idea. You've had the patience. You are in a small position. If we didn't get the turnaround today, and in fact we were 1 penny higher than that 513 high of last week, I would be saying to you, you can add a little bit more if we close here. Maybe don't do it today. Wait until Tuesday to see if there's a pullback. But if it's holding well, you could add a little bit more. But you know what? I think today's action is telling you we're in for a very volatile January. And that's basically, you've got to be careful.
I'm short a little bit. Yeah, I'm just going to be patient here, I think. Like you, I'm looking for a higher stock market in the future, but in the short term, it's,
Yeah,
it's timing,
and
right?
I don't want to keep getting my head handed to me by wanting something, jumping for it. So I've been very patient trying to do it. We've had even today we tried to go long. We took a 1% loss on a very high percentage long position, 300%. 1% on one of those is just nothing. I mean, it's just to be able to have that opportunity to take a chance and then get stopped out for only 1%. I prefer that than to suddenly see something go against me like this. For instance, if Monday turns out to be a really terrible day and Tuesday follows through, it's going to make it very hard for ASG to get back to even today's high of 512. So I think your patience is going to be worth it. And you know what? All you're missing is opportunity now. And opportunity we can always make up. Hey, Mike, I think you're on the right track. Thanks for calling. Let's look at it again in about a week.
Basil, one second.
Yes.
You mentioned the continuous commodity index, the old commodity. You can see that on the symbol GCC, which is an ETF that started in 2009. It replicates the old CRB.
Oh, my goodness. I just pulled it up.
Yeah.
Oh, it doesn't go back long enough, but it's great to have. It's really, thank you.
Also, if you want to see longer-term work on the old CRB, go to the website called chartingyourfutures.com.
I did that once, and then I forgot all about it. Charting Your Future.
Yeah.
Someone mentioned it. Yes,
and he
I've written it
updates that
down.
daily. Yeah.
Hey, thank you very much, Mike.
You're welcome.
Have a great weekend. Thank you
too.
very
Bye-bye.
much for the information. Let's go to Dan in Baskin Ridge. Dan, how are you?
Doing well, Basil. How you doing?
Good.
Hey, Basil, I was looking again at XIV. I actually, 2 days ago, got stopped out, went back in, and I actually took a measured position, went in a half, and then got in a lower half. So I'm doing okay in the position now. I'm in, probably about 29 and a quarter. But I wanted to see what your thoughts were, because I was looking at it, and it looks like it might be a peak C this morning on an hourly chart. And I was wondering if you might, what your thoughts were about this getting back up to, the 34 or so.
So let's just talk about this, because I've been very worried, and I just have not had the time to go to have a look at the actual makeup of the XIV, which is the VS inverse VIX short term. I need to explain to myself, or have it explained to me, why the XIV, which is the inverse of the VIX index, failed completely to rally as the Dow and the S&P did back on the December the 26th It made an H pattern and broke down and went to a lower low. It is failing miserably to match, and there's something going on in the mix. And the back of my mind, I think I've nailed some part of that, and that is the makeup is, in this case, we've had very few when the majority of stocks, the Dow stocks, or the stocks that are involved in the XIV, have closed to the highs of the day. I think that might be it, but I'm not sure. Probably Dave might have a great answer on that. But the XIV is not performing very well. In fact, even this morning, I thought, should I get the XIV rather than the Dow position that we got? And instead, I went for the other because I knew I could handle that a little bit better. But in this particular case, the XIV is showing, right as we're speaking, it's showing better internal strength, interestingly enough, than some of the other indexes that I'm looking at that would be related to this. Now, so the XIV, you've got a position at 29, in the 29s, and it's at 30.78 right now, minus 83. This is what I'm going to suggest to you. On a percentage basis, you're going to do very well if there is that struggle that I'm looking at to just normally make a new high and then pull back and then go sideways to slightly down and then woof, have another spike to another new high later in January, and then we've got to be really careful. So if I'm correct in that assessment, probably this is not a bad vehicle because you can manage the trade, especially since you usually enter very nicely. Now I'm looking at this in the weekly chart. You see, doesn't have the same kind of strength at this particular point in the MACD and the slow stochastic as if I take. I'm not even sure what the XIV is based on. Let me just, for argument's sake, go to the NYA.X, which is the New York Stock Exchange. You see, that's having rising highs and rising lows at this particular point. And it has quite a different chart pattern. So I'm going to deal with the XIV chart as I see it. And I'm going to just suggest to you that the 120-minute chart is saying to me quite loud and clear that I'd be a little bit careful if the low of 30.12 on the candle that closed at 11:30 this morning on the 120-minute chart is taken out. If that's taken out, my recommendation to you would be at least cut back on your position. But here's the opposite side. If all the selling is done, I'm not sure it is. I'm just saying if all the selling is done. I'm not sure it is. Why? Because the VIX index at this particular point is... Oh, it's under the 9-period moving average right now. Okay, so that's a good... Oh, look at that. You know what? The VIX is saying to me that at 17.48, if at any point today the VIX suddenly spikes and goes above 70, goes above 18, especially if it goes above 1842, that's a real problem. But if it starts to fall between 17.20, 20 cents lower than it is now, that's going to be a really good sign. You should see a commensurable move in the XIV. That's how I would trade. Do you put the VIX up at the same time as you put your XIV?
No, I look at basically just look at the price action on the XIV versus what the market's doing. Because like even on TVIX, when the market was down, so when the Dow was down, and S&P down about an hour ago, it was only up like 5 or 6%.
Yes.
Versus 1% move, you should be up like 10% in the TVIX.
So, okay, here's my recommendation. I think you have your eye exactly on the price. I'm just going to suggest put the VIX on a 60-minute basis up. Watch it closely. It's at 1735 now. If it starts to drop and it keeps sliding, you want to see the market moving up together with the counterpoint of the slide down. But I think you've got your eyes on the prize. Yeah, you might have a winner by the end of the day. Thanks for calling.
Basil.
Thank you, Dan. We'll go to Mohammed and Jay as soon as we get back. Basil Chapman, Tiger Admissions Hour. Dow's only down 140 now, and the S&P's down 50. I'll be right back after these messages.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. The Art of Timing the Trade Charts has officially launched at TFNN. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind software, The Art of Timing the Trade Charts allows you to scan for Fibonacci formation setups, including Gartleys, butterflies, ABCs, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the market for stocks just beginning to form the trading patterns that many investors spend days, weeks, and even months searching to find. As part of our introductory pricing, we're offering licenses available at only $59 per month. We're so confident that you'll love this new outstanding piece of charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Lock in your low price today by ordering your copy at TFNN.com.
Learn about good health and fitness. Living a primal lifestyle with Nico and Paige. Next on TFNN.
Hi, folks, we're back. Boy, we got a lot going on here. So I'm going to go to Mohammed in Glendale. Hi, Mohammed. How are you?
How are you doing, Basil?
I'm well, thank you. You'd like to look at?
Celgene, CELG.
Now, do you have a position in Celgene?
I was trying to get into it. So wanted to get your thoughts, maybe around 112.
Okay, so here's my thinking about Celgene. Folks, Celgene, of course, one of the great biotech companies, made an all-time high last month. It's making this H pattern, this cup pattern at the top. I tell you what, if I had to say, you like to get into a position and it's more kind of an intermediate term position. You'd like to have this for weeks and you'd like to see it move up, even if it's just steadily. It doesn't have to do anything great, but it's downside risk that you're really looking at. You want to curtail. Is that correct?
Correct.
Yeah, so I'm going to make the suggestion. Let's look at it again next week. I'm of the opinion that the IBB, of which Celgene is a very important part, is starting to work just way too hard. It's starting to. It is what I call wheel spin. It's like when you're on sand, you start the car and you put it into first gear, or you start off, and the wheels spin around. You're not going anywhere. Here it's ice that we do the same thing on. I would prefer that you got all-wheel drive right now, and it's not showing that. I'm a little concerned. So I'm going to suggest, I could be totally wrong, and you'll look back and say, oh, Basil, I missed another big 15% gain on one of these, these biotechs. They just constantly move higher. I think it's starting to stall. I can see it going to 118 on the next bounce. So if you want to play that, that's one thing. So here's what I'm going to suggest to you. If you're looking for the longer term, I'm not even sure if it's worth your situation right now just to even buy, like I would say, start a position at 113.53 on that kind of price stock. It's a 3-point stop is not a big deal. 3%, I just don't think that's an issue at all. And then I would add to that position as it took out 117.45. I'd add a little bit more, and the moment it crossed the old high of 119.84, I just tightened up my stop, but it would be a smallish position altogether. I don't know if that's for you, because you really, I'm pretty sure you'd like to put your position on, and then you're prepared to hold for a little bit of a loss as long as you know that you've got substantially higher gains. And I don't see that as this. I'm not comfortable saying to you, do anything other than the strategy I just proposed, which is maybe take a tiny position now. You can add to it on the break of yesterday's high, and you can add to it again on the break of the high of about the 19th of December. I don't know if that really suits your position. So you could do that, or call me Wednesday of next week. That's going to be a perfect time. We'll see what the markets are doing, see what the IBB is doing, because I might say to you, not the time at all to go into Celgene. So give it. I'm prepared to sacrifice my call to say to you, I'm a little cautious here. I can see 4 or 5 points maybe. I think you're looking for more than 8 to 10 points gain, and if that's what you're looking for, I'm going to say to you, let's wait a little bit and see how it holds over the next 2-3 days. Is that okay?
Yes, that sounds
okay.
Good. Thank
you so much for calling. Well, let's go to Jerry in the back bay. Jerry, got a moment here. You'd like to look at EDV. Now, this is directly related to the price point of TLT, right, of bonds.
Yeah, it's a 30-year bond. It's more aggressive, yeah.
Right. The 20-year is the TLT, but the chart pattern and the count that I've got is almost the same as the thing. So you are long, and I'm going to make the suggestion here that based on the TLT, I'm toying with the idea of where one would start to look at the TBT, which is the opposite. I think you're okay for now. The way it's looking is that there could be another modest high of 132.50 coming into Tuesday or Wednesday. But I don't want to see 127 on the TLT break. I'm going to talk about it more on Monday and Tuesday. Okay, Jerry?
Yeah, you got to go. I know. Thanks a lot.
I got to go. Stay tuned, folks.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TF